So, oh. Good afternoon. We are Aflore, a community of mobile-enabled informal financial advisors for the emerging middle class. Financial services can be the solution for development, but there are some myths around financial inclusion that need to be debunked. Myth number one, the emerging middle class does not use financial services. Reality, they use financial services, but mostly informal, for every person that takes a formal loan to take it from family and friends because they trust them. Myth number two, emerging middle class does not have access to financial services. Reality, they have access, but at a high cost or with an inadequate product offering. In Aflore, we are solving this problem by combining the trust that exists in direct sales network, high touch, with the power of technology to efficiently risk assess this demographic, high tech. We have created a new distribution channel for financial products through our network of informal advisors. Informal advisors are very well known in their communities, and they know them also well. We recruit them and equip them with a platform so that they can offer our products to their networks, and for doing so, they receive benefits for every product they place. We have created a frictionless platform so that our community, so that our informal advisors can become their community bankers, like the case of Rosita. Rosita owns a small bakery and has already given 16 loans over the 20 months since she joined Aflore 20 months ago. Her neighbors trust her. Luz Dari, for example. Luz Dari owns a restaurant 2 houses down from Rosita. Luz Dari often stops by Rosita's bakery to have a coffee, and it was in one of those conversations when Rosita offered Luz Dari a loan. They submitted this through our loan application through our app and received a response very quickly. Luz Dari has paid well her loan and has renewed it already 2 times. And well, Rosita has benefited from Aflore as well. She has earned the equivalent of 2 months' wages, money she saves in the Aflore app. She's an active member of our Facebook Live communities, and she has met other informal advisors in her neighborhood. Tech is fundamental to our community. Our app has been designed so that people without specialized financial knowledge can offer products with just a few clicks. In the operational back, our tech makes it possible to efficiently serve our community of informal advisors and risk assess a demographic with little credit history. We have over 6,000 active informal advisors that have disbursed $14 million in loans and insurances to over 20,000 clients over the past 5 years. These loans have an excellent risk performance. We pass due loans at 6.5%. And 75% of our informal advisors are women. We are creating strong social impact by enabling financial inclusion through women-led conversations. Our ambition is to become the channel for reaching the emerging middle class. We have a replicable model that can be applied in those regions where direct sales and informal financing prevails. It's a profitable model. We have low origination costs by leveraging on the network effect of our informal advisor community. And it's a distribution channel for all. On top of providing our own products, we partner up with aligned financial institutions and other fintechs to distribute their products through our network. Combined, we have over 30 years experience in financial services, tech, direct sales, and entrepreneurship. Through Aflore's model, we are making possible low-cost relationship banking for the emerging middle class, high touch and high tech to promote inclusion. Thank you.
Thank you, Aflore. Woo. And now we're going to reset the clock. 5 minutes, judges. Any questions for Aflore? One from Mr. Seth.
Could you elaborate a little bit more about the fraud risks with the third-party model and how in your approach you are mitigating that?
Yeah, we have different checkpoints for fraud through the process. So we do AML and KYC for both the informal advisors and the client when they ask for a loan. And then we check the relationship between them also in our verification process. The underwriting process is on us. So the informal advisors only provides information, collects information from the client. We do all of our verifications, we check the bureaus, we check the government list and so on, and then we take the decision. And then the informal advisor helps us with the collections of the loan. So at the end, it's only a provider or part of the origination process.
We got a question from Mr. Bokaya.
How scalable is your model? I see this as more of a people-driven model and through your connections with the society at large, rather than technology.
Well, it's a combination of both. No? So we believe that for financial inclusion, tech matters, but also relationship, it's important to create trust. So at the end, we have three ways of onboarding these people and recruiting informal advisors. One is using the direct sales strategies that are already developed. The second one is digital. So we do Facebook campaigns, digital campaigns, and we get the informal advisors there. And then we have the onboarding process. And the third one is partner it up with existing networks. For example, again, these direct sales companies, or for example, fast manufacturer, consumer industries or companies that already tap or have networks, for example, of mom-and-pop stores that we are able to convert through our process, training them and giving them our technology. So at the end, it's scalable because we trust on people, but we have a very scalable process.
We've got a question here from Mr. Chi over there.
Just talk a little bit about your funding sources, so who's providing a source of funds, and then also on the back end, how does collections work, given that this is quite an informal network.
Okay, so at the end, we have three business lines, as you said, you saw here. The first one is we lend from our own balance sheet, and for that we have to fund ourselves. So we have already raised like more than $6 million through different sources. So we have family offices, we have impact funds, we have foundations that are keen to serve this population, and they are looking for operators. So they are very keen to fund ourselves at a low rate, and then we can place that loans to the final customers. And then we have the other business lines that is co-creating products with financial institutions, and usually those co-branding partnerships are funded by the partner.
Okay, we got a question here from Mr. Ong.
Do you manage the quality of your network of informal advisors?
Yeah, of course. The model is prepared for. So the model learns, and the informal advisor have a journey. So when they start, they are only able to serve a certain number of clients with little loans. And once they prove themselves as being a good informal advisor, we enable them to go farther into their circles of trust with higher loans and better prices.
Thank you, Mr. Ong. We have a question.
Yeah, I was wondering what's your interest rate they charge them as compared to the informal network, and also what's the loss ratio?
What, sorry?
Loss ratio.
Yeah. So we are working now in Colombia. That is a regulated market for the rate that you can use. We are lending at 33%. Actually, it's 30% plus 3% on insurances and on other products. Compared to, for example, the microfinance world, microfinance sector, it's much less less than half, because they are able to place at 60%. The loss rate it's below 6%. That is also half of the microfinance institutions sector.
We've got about 45 seconds left. If it's a quick question, I think we can do just one quick question. No? All right, everybody. Aflore from Colombia. Thank you so much. Thank you.